Hello, everyone, and welcome back to the GMS Weekly Podcast, where we break down the key developments shaping the global ship recycling markets.
It's week 22 of 2026, and after 7 weeks of waiting, the market finally got the headline it had been looking for.
A tentative agreement between the United States and Iran to extend the ceasefire, begin demining operations, and move toward reopening the Strait of Hormuz.
The deal that has been anticipated for months.
Exactly. 3 supertankers crossed Hormuz during the week. Diplomatic negotiations advanced, and oil markets reacted immediately.
Brent crude dropped sharply, falling back toward the $96 to $97 range.
A significant move considering Brent was trading above $105 just a week ago.
So, from the market's perspective, the deal appears to be real.
Real enough to move prices, but not yet real enough to change the physical situation on the ground.
Because the agreement is still tentative.
Correct. Final approvals are still pending, negotiations remain unresolved on several major issues, and military incidents continued during the same week the framework was announced.
Which means the strait may eventually reopen, but it is certainly not back to normal yet.
Not even close. The Pentagon is estimating that demining alone could take 6 months.
And for ship recycling, 6 months might as well be 6 years.
That's the key point. The timing simply does not work.
Because while diplomacy may finally be moving forward, the monsoon does not wait.
Exactly. The beaching window across the subcontinent is effectively closing now, regardless of what Washington and Tehran agree to next week.
Which creates one of the biggest ironies of the entire year.
It does. The financing constraints that dominated the first quarter have largely disappeared. Oil prices are falling. Diplomatic momentum is improving.
Yet the ships still are not arriving.
And that remains the defining feature of this market.
Even freight markets are reinforcing that story.
They are. The Baltic Dry Index actually strengthened this week, rising above 3,100.
So despite the peace deal, earnings remain attractive.
Very attractive. Capesize earnings moved back above $44,000 per day.
Which means owners still have a compelling reason to keep older vessels trading.
Exactly. The economic incentive to recycle remains weaker than the incentive to continue operating.
So the supply shortage survives another week.
It does. In fact, the peace deal may have reduced one reason to sell without creating a new reason to do so.
Let's move around the recycling destinations, starting with Bangladesh.
Bangladesh remains one of the most stable markets in the basin.
The taka barely moved again.
That's right. It continues to trade comfortably within the same band that has held throughout the entire second quarter.
Which is impressive given everything that has happened over the last 2 months.
Very impressive. The currency has remained stable through the war, through the diplomatic volatility, through oil spikes, and now through the peace negotiations.
And this week was also affected by Eid.
Yes, Eid al-Adha effectively brought activity to a seasonal pause. Yard operations slowed, cash buyer activity quietened, and most participants were focused on the holiday period.
So operationally, it was a very quiet week.
Quiet, but with an important backdrop. Bangladesh now has one of the healthiest financing environments it has seen since the conflict began.
The LC pipeline is functioning normally.
Exactly. The financing problem that constrained buyers earlier in the year has largely disappeared.
But now there are no ships to finance.
That's the irony. Demand exists, financing exists, but the tonnage still does not.
And with the weather window closing, time is no longer Bangladesh's ally.
Precisely. Bangladesh has the demand. Bangladesh has the financing. Bangladesh is about to lose the weather.
Moving to India, this was probably the most positive currency story of the week.
Definitely. For the first time since the conflict began, the Indian rupee staged a meaningful recovery.
Falling back from the record low near 97.
Down to roughly 95.78 by the end of the week.
That's a substantial move.
It is. The market is clearly pricing a higher probability of Hormuz reopening and lower.
But you're careful to say probability, not certainty.
Exactly. The deal is not finalized, the strait remains mined, and several major political questions remain unresolved.
So this is a repricing of expectations.
Not a confirmation of reality.
Did the stronger rupee help Along's position?
Marginally, local steel prices improved slightly in dollar terms, but India remains the lowest price destination in the subcontinent.
And the bigger issue remains unchanged.
Supply. Alang has spent the entire quarter waiting for vessels that never arrived.
And now the monsoon arrives before the ships do.
That's really the story. The rupee recovered, steel improved, compliance remained strong, but none of those factors generated tonnage.
Pakistan continues to be remarkably stable,
It does. The Pakistani rupee held almost unchanged for a third consecutive week.
which is quite a contrast compared with the volatility elsewhere.
Absolutely. Pakistan has quietly become the most stable currency story in the region.
And the state bank's earlier rate hike appears to have achieved its objective.
So far, yes. The currency remains anchored, reserves are being managed carefully, and remittance inflows have helped support stability.
Aid also slowed activity in Gadani,
Similar to Bangladesh, the holiday effectively paused operations and pushed any meaningful market activity beyond the practical recycling window.
yet pricing remains extremely strong.
Very strong. Gadani continues to hold the highest steel plate values in the subcontinent.
So Pakistan ends the quarter with strong pricing, a stable currency, and improving infrastructure.
And exactly the same challenge as everyone else.
No ships.
No ships.
Finally, Turkey.
Turkey remains the outlier. While most currencies stabilized or improved on the peace deal, the Turkish lira weakened again,
Reaching another record low.
around 45.9 against the dollar.
So Turkey's challenges remain largely domestic.
That's right. Unlike the rest of the basin, Turkey's inflation and currency pressures are increasingly driven by internal structural issues rather than developments around Hormuz.
The central bank also revised its inflation outlook higher.
Significantly higher. That revision effectively acknowledges that inflation remains a much larger problem than policymakers had hoped earlier this year.
And for ship recycling?
Very little changes. Aliaga remains focused on the EU-regulated segment where compliance matters more than price,
So Turkey continues operating in its own market.
exactly as it has throughout the quarter.
Looking at the broader picture, this feels like the conclusion of a longer story.
It does. For 7 weeks, the market focused on whether diplomacy would arrive in time.
And now we have the answer.
Diplomacy arrived.
But timing did not.
That's the takeaway. The deal has been struck, oil has fallen, the rupee has recovered. The strait may eventually reopen.
But the recycling market still did not receive the one thing it needed.
Tonnage.
And now the monsoon becomes the dominant variable.
Exactly. The passage may finally open. The beaching window has already closed.
That's the story of week 22.
That's all for this week's update on the global ship recycling markets.
We'll be back next week with more insights.
Until then, stay safe.
And thank you for listening.